Before the break, I highlighted the top 10 winners in the S&P 500 for 2021. You know what? I actually think you can learn a lot more from the losers, especially the ones that took you by surprise in the second half of the year. The worst performer? Penn National. Yeah, Penn National Gaming, down 40%. Every year there's some red-hot concept that draws a ton of competition, sinks the whole group. Last year's can't miss was gambling. The earlier 2020 merger between Penn National and Barstool was supposed to connect the hottest entertainment property in media with a staid gambling business looking for pizzazz. Unfortunately, a lot of other gambling-related companies had the same go big or go home ideas, from digital players like FanDuel and DraftKings to old-school casinos like Caesars, we're all Caesars, to foreign outfits like PointsBet looking to cash in on a growing market. And competition is just plain old bad for business. Now, once every state allows gambling and we get some mergers here, I think there'll be a lot of money to be made. Penn National is a very well-run company with a terrific CEO. I can say the same things about DraftKings. But until we get more consolidation, more states legalizing gambling, and most important, COVID goes away, Penn National will be tough to own. It might take a year for things to turn around if this Omicron hangs out. Second worst performer, Global Payments. That was down 37%. Now, this stock used to be such a perennial winner that it felt like you couldn't possibly go wrong by owning it. Global Payments is a preeminent financial technology play that's an essential part of the credit card food chain that partners with 200 large banks and 1,000 smaller ones. As their website points out, and I quote, outsource all of your technology to us and we'll run it for you, end quote. Here's the problem. I could have said the exact same thing about a half dozen other companies in this business, or even a dozen if everybody in the industry were to come public. That's a big reason why the whole fintech edifice collapsed under its own weight last year. Too many companies chasing too few accounts, with many of them doing better than others. Not that any of us can tell. I've always admired Global Payments, as well as the card issuers and the small business empowerment plays and the buy now, pay later outfits, but there's just too many darn stocks in the group. They're all too expensive, especially compared to the super cheap bank stocks that rallied today that should get a huge profitability boost as the Fed raises rates.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.